Hey everyone, it's Clint Brewer here, Larry's analyst over at the Opportunistic Trader, and we wanted to come to you today and break down a trade that we recently closed out for a nice gain. Commodities have been in the headlines a lot here lately, especially with precious metals and the news we're seeing in gold and silver. But we've actually been very active in one ticker trader in trading USO. So USO is an ETF that tracks crude oil prices. We've done a number of trades there since around the fourth quarter of last year. That's extended into this year as well. We've seen some good volatility that we've been taking advantage of. And so today I wanted to come to you with the latest trade that we closed out there and break down some of the things and levels that we were watching. All right, so here's the chart of crude oil prices. This is specifically West Texas Intermediate. And again, I want to make the distinction here. I want to break down what we're watching specifically with oil prices, but the way we took advantage, the way we traded this is with the USO ETF, specifically options on the USO ETF that tracks oil. And I'll get more into that here in just a moment. But I just want to show the overall. I took this chart back a little over a year to show kind of the bearish trend in place for oil prices. So you can see going back, I could extend this chart back further and you'd see something similar where I just kind of locked in this downtrend. You've got lower highs along the way. More recently in 2025, oil prices were coming down to test this $57 level on a couple occasions. So that became a key level to watch, especially during the back half of the year. We created this bearish descending triangle pattern. If I could draw a trend line connecting these tops right here along with this low, so you're watching for a break below this pattern would be a bearish development for oil prices. And that's, exactly what you had at point one, where you had oil prices, again, break below this pattern. But there are reasons to become bullish when that happened, both from a fundamental side and a technical side. More on the fundamental side, when you get oil prices down to these levels, I'd like to say low oil prices are the things that can lead to high oil prices. And it's because you're getting prices down to a level that discourages new production. Whether it's OPEC members need to see much higher prices to bring their state finances into balance. U.S. shale producers, they've really emerged during the shale revolution as a key swing producer of oil. And once you start getting into this $50 per barrel area, it starts to become unprofitable to bring new production online. So that was one thing. The other thing is that oil prices at these levels do not, in our opinion, do not reflect the growing geopolitical risks that were out there. Those risks have always been present, so to speak, especially going back to last summer. But with oil prices continuing in their downtrend, there was less and less appreciation for those risks, and so that was another catalyst as well. On the technical side, one thing to watch is very, very, very slight, but when you had oil break below this pattern, make this lower low at point one, you had a slightly higher RSI level. There's two things on the RSI. One is you got back down to close to an oversold reading. But this low was, again, it's not huge, but this low was slightly higher than that prior low. So you start to see a positive momentum divergence there. And so when you have the technicals starting to collide with the fundamentals there, and that put us on attention. Now, specifically on this most recent trade we put on, again, we've been pretty active in trading USO and one ticker trader going back to the fourth quarter of last year. But on this most recent trade, what we watched was prices, fell to point one. There's conditions in place to see a rally. We came back up. It struggled. This blue line on here is the 50-day moving average. You can see going back to September, the oil prices have been in this downtrend, have really struggled to get above the 50-day. So it came back to test the 50-day from below again, then pulled back. And so this is where we got interested. We were pulling back and coming back to test a level similar to this low at point one. We didn't add this most recent trade exactly at that low. It was the day before, but what we did was we took a long position in USO calls that expire in April. I believe they had an exercise price of $75 per share. So that was the trade we added at this arrow. Again, just under appreciation of some of the geopolitical risks that were out there, and on this move lower to come back and come close to testing support. This, in the strictest sense, this is not a positive RSI divergence because price did not hit that exact low or make a lower low. But you can see the RSI holding up at a much higher level on that pullback. So just it seemed like there's positive momentum, divergences starting to build with oil prices, and then you had this. I think this was following the Venezuelan events. You had this big move higher. This was a really meaningful break above the 50-day because again, oil prices have really struggled going back 3 or 4 months to sustain any move above the 50-day. But when that happened, that's when you saw more buying pressure really emerge to push oil prices higher. And, we got that short-term move that we were looking for. We exited this trade in 2 separate trades. So we sold half of that position, I think on the 13th, and then closed out the remainder on the 14th, which happened to catch that high right there. And so we were able to close out that USO trade. Considering both legs of the trade, it was a blended return of about 77%. So, those were the things that we were looking for with USO, with oil. Geopolitical risk and they're appreciated, oil prices getting pushed too low, creating the conditions there to see a snapback rally higher, which is exactly what we saw. And so we had another trade there for our subscribers in One Ticker Trader.